The real myth wasn't invented until centuries later, when the world faced a crisis so big, so global, and so terrifying that leaders had no choice but to lie, or watch civilization fall apart. The rise, how the myth took over. To reveal the myth, we move forward to the 20th century, a century defined by war, reconstruction, and unprecedented financial ambition. The gold standard breaks. By the mid-1900s, world economies were growing faster than the supply of gold. Nations spent money they didn't have, printed money backed by gold that no longer existed, and competed in a race of economic expansion fueled by debt. Then came the breaking point, 1971. President Richard Nixon closed the gold window, officially ending the convertibility of the US dollar into gold. It was the moment money became completely unmoored from reality. A dollar no longer represented something. It simply was a story, a belief, a myth. But here's where the trillion there's a number so big, so absurd, and so casually accepted that it has quietly become the scaffolding of the global economy. Most people never question it. Governments depend on it. Financial markets worship it. Entire social systems are built on it. And yet, it isn't real, it is a myth. A trillion-dollar myth. A myth that keeps the system alive and might be the very thing that destroys it. Tonight, we're going to uncover the hidden story behind this trillion-dollar illusion. A story that stretches across centuries, touches every major financial crisis, and still shapes the way your bank account, your job, your government, and your future function right now. But to understand the myth, we first have to understand why the world needs it. Because without it, the entire system collapses. And here's the twist. The people who built this myth knew exactly what they were doing. Setting the stage, the origins of the illusion. Before we go into the timeline, we need to set our stage. Who built this system? Why was it created? And what was the original problem it was supposed to solve? To answer that, we go back, not to 2008, not to the dot-com bubble, not even to the Great Depression. Our story begins in a far more unexpected place, the birth of modern money itself. When money became a promise, at one time money wasn't abstract. It represented something, physical gold or silver, held somewhere you could touch. A dollar wasn't a dollar. It was a claim on something real. But governments hated this, because real money limits power. It limits spending. It limits how fast nations can expand. And most importantly, it limits debt. So slowly, quietly, step by step, money transformed from a claim on something real into a claim on something imagined. A promise, a belief, a story. And belief-based systems require myths. The first great myth maker. Enter the early central banks, starting with the Bank of England in the late 1600s. These institutions weren't just banks. They were myth manufacturing machines. They introduced an idea the world had never seen before, that money can be created out of debt, and debt can be repaid with new money. This loop, this circular logic, became the foundation of the modern financial world. But this wasn't the trillion-dollar myth. This was only the stage. All our myth gets born, not in what happened, but in what had to happen next. The new problem, infinite money, requires infinite growth. Once money became unlimited, the economy had to become unlimited too. Why? Because debt grows exponentially. And if the economy doesn't grow fast enough to pay back the debt, everything collapses. This is where the myth enters. To keep the system alive, you need a narrative powerful enough to justify infinite growth. As long as we keep expanding, the bills will never come due. This belief slowly evolved into something even bigger. Debt doesn't matter, because we can always create more money. And then, the final stage, crises can always be solved with more liquidity. This belief system became the backbone of global finance. But a belief system only works if people don't question it. So, to protect it, people were taught to stop asking questions. The myth succeeded, for a while. When the myth was exposed, every myth has its stress test. And the trillion-dollar myth faced its first public failure in 2008. The 2008 crisis. The curtain is pulled back in 2008. The world saw something terrifying. Banks ran out of real money. In theory, the financial system was supposed to have safeguards, collateral, reserves, capital requirements. In practice, those safeguards were built on assumptions, and those assumptions were built on the myth that systems were too big to fail, that debt could always be refinanced, that liquidity was infinite. When that illusion cracked, the truth came out. The world didn't have the money it thought it had. Not even close. The system survived only because trillions of dollars were created out of nowhere, instantly, magically, proving that the myth, while fragile, was also essential. The public saw the magic trick. But instead of demanding a new system, the world chose to double down on the existing one. Why? Because the alternative was too terrifying. The myth mutates, quantitative easing. After 2008, the system needed a new narrative to justify trillions being created out of thin air. It found one. Quantitative easing, or QE. QE was essentially a rebranding strategy, a marketing campaign. It told the world, don't worry. This isn't money printing. This is a sophisticated temporary tool used by experts. But experts knew better. QE was simply the myth made official policy. The myth that we can print trillions with no consequences. But there were consequences, they just weren't immediate. Instead, they built quietly, invisibly, accumulating pressure like steam inside a sealed container. The price of believing the myth. The fallout didn't look like a crash, at least not at first. It looked like asset bubbles. Surging inequality. Record corporate debt. Housing markets that became untouchable. A stock market that rose faster than the real economy. And governments that spent more than ever before. All justified by the same myth. Debt doesn't matter because we can always create more. But what does fallout look like when a myth starts to weaken? It looks like the cracks we see today. Governments with debt-to-GDP ratios once considered impossible, corporations borrowing not to grow, but to survive, consumers living on credit to maintain basic lifestyles, economic growth slowing while debt grows faster. Inflation reappearing after being declared solved forever. The system didn't collapse. It simply became addicted. We built an economy where removing the myth is no longer possible. And that's the point. The myth's purpose was never to be true. Its purpose was to keep the machine running. Why reforms never work whenever crises occur? Leaders promise reforms, stronger regulations, more oversight, better risk management, stricter lending rules. But these fixes always fail for one reason. Fixing the system requires admitting the myth isn't real, and no one wants to do that. Section: Why real reform is impossible. A real solution would require slowing growth, reducing debt, letting bad banks fail, letting unpayable loans default, allowing asset prices to correct. But all of these actions would cause short-term pain. Politicians don't get re-elected during pain. Corporations don't survive pain. Banks certainly don't survive pain. So instead of solving the problem, the system delays, postpones, refinances, stimulates, and prints. Every intervention becomes larger than the last. Until eventually, interventions become the system. That's when a myth stops being a story and becomes a survival mechanism. How the myth shows up today. This is where things get uncomfortable. Because if you look closely, you can see the same patterns repeating again, right now, with even higher stakes. Governments today? Governments worldwide now run perpetual deficits. They borrow more each year than they bring in. Why is this allowed? Because the myth says it doesn't matter, as long as the economy grows faster than the debt. But here's the shocking data. Global debt has reached over $300 trillion, with only $100 trillion in global GDP. Debt is growing 3 times faster than the world economy. Over 60% of developed nations now have debt-to-GDP ratios previously associated with crisis conditions. The math no longer works, unless the myth holds. Companies now routinely survive by issuing new debt to pay off old debt. They call it refinancing. But in any other context, it would be called what it is: a Ponzi structure. Not illegal, but structurally identical. Consumers. For households, the myth shows up as credit card debt at record highs, housing price beyond reach, wages stagnating while expenses climb. The normalization of buy now, pay later for basic necessities. Consumers aren't thriving. They're floating, kept alive by the same belief. As long as income comes in later, borrowing now is fine. It's the individual version of the trillion-dollar myth. Markets. Today's markets behave as if central banks will always bail them out, interest rates will always drop again, money will always remain cheap. This belief isn't rational. It's not economic. It's mythological. And it's the same myth that kept the 1920s booming until it didn't. The same myth that kept the 2000s booming until it didn't. The same myth that kept 2020 stable until inflation exploded. History doesn't repeat, it rhymes. But economic myths? They repeat exactly. The trillion-dollar myth. So what is the trillion-dollar myth? Let's say it plainly. The trillion-dollar myth is the belief that debt can grow forever, without consequence, because we can always create more money to pay for it. It's the myth that money printing has no limit, low interest rates can last forever. Every crisis can be solved with liquidity. The economy must always grow, and that someone, somewhere will eventually pay the bill, but here's the truth. No one plans to pay it. And no one ever will. The system functions because everyone believes the myth at the same time. If that belief breaks, even slightly, the system falls apart. That is why the myth must survive. 3 takeaways. 1. Debt isn't the problem. The assumptions about debt are debt can be productive. Debt can fund innovation, growth, infrastructure. But the assumption that debt can expand infinitely is the myth, and it's mathematically unsustainable. 2. Crises aren't failures. They're pressure valves. Every crisis you've seen, 2002, 2008, 2002, wasn't the system breaking. It was the system adjusting, releasing pressure, delaying consequences. Each time, the fix required more debt than the crisis itself created. And that is the danger. 3. The myth survives because no one wants the alternative. The alternative to the myth is a world where growth slows markets, shrink assets, correct governments, cut spending, consumption declines. No leader wants that. No voter wants that. No corporation wants that. So the myth lives because it must. Or open question. Here's the question we now face. How long can a system survive on a myth once the public begins to recognize it? History tells us that myths last until they don't, and when they fall suddenly. Not gradually. Not predictably. All at once. If you found this breakdown useful and want more deep dive videos that challenge assumptions and peel back the layers of the systems that shape your life, subscribe and hit the bell. Share this video with someone who still believes the old narrative, someone who trusts the myth without realizing it. Because the more people who understand the truth behind the trillion-dollar myth, the better prepared we'll all be when the story finally changes. Thanks for watching. Stay curious, and I'll see you in the next one.